Every Monday to Friday, this is Peter Lewis's Money Talk.
Money Talk.
Good morning, this is Peter Lewis, welcoming you to a new week of Money Talk for Monday the 18th of February. We have reaction to an analysis of the day's top business and finance news coming up. This podcast is sponsored by Surfing Group, which is headquartered in Singapore and offers online financial services to 30 million customers across 10 countries. In today's business and finance headlines, Mainland China's markets reopened this morning after the Lunar New Year holidays. Hopes are high for a catch-up rally in Shanghai and Shenzhen after the Hang Seng China Enterprises Index of Chinese companies listed in Hong Kong rebounded 4.7% last week and reducing its losses for 2024 so far to 3.6%. In the US, the Nasdaq Golden Dragon China Index jumped 4.3% for the week. The People's Bank of China left the rate on its one-year policy loans, known as the medium-term lending facility, unchanged at 2.5% on Sunday, as expected. The decision came as the PBOC sought to ease more pressure on the yuan and to assess the impact of recent support measures for the economy. The central bank also made a small cash injection of 1 billion yuan into the banking system, the smallest infusion since last August. Early travel and spending data from the Lunar New Year holiday offered some signs of a pickup in consumer spending. Online hotel bookings and spending on delivery giant Meituan's platform saw hefty gains. Official figures showed people made more journeys than ever before, with tourism revenue also at a new high. According to the Ministry of Culture and Tourism, more than 474 million domestic trips were made during the 8-day break. That marked an increase of 34% year on year and also up 19% from 2019. Singapore's Deputy Prime Minister and Finance Minister Alex Wong presented the government's 2024 budget on Friday. In his budget speech, Mr. Wong announced that the city-state will increase support for households and companies as the country continues to grapple with higher prices. The government will be providing more MAP vouchers and cash handouts to Singaporean households, as well as rebates for utility bills. Mr. Wong also announced that there will be a 50% personal tax rebate for 2024, and in addition, all companies in Singapore will get a 50% corporate income tax rebate, capped at 40,000 Singapore dollars. And cash payouts of at least 2,000 Singapore dollars will also be given to companies who hired at least one local employee in 2023. On today's programme, I'm joined by Alex Wong, Director at Alex KY Wong Asset Management, and Louis Kuijs, Chief Asia Economist at S&P Global Ratings. And providing a view from mainland China will be Shanghai-based independent economist Andy Scher. And don't forget, if you want to get in touch, please post your questions or comments on my Money Talk website at peterlewismoneytalk.substack.com.
Peter Lewis's Money Talk.
US stocks declined Friday after yet another hot inflation report stoked fears that the Federal Reserve may not cut rates until later than anticipated this year. The S&P 500 spent much of Friday's session oscillating between small gains and losses, but an afternoon sell-off ultimately left the benchmark down 0.5% at 5,006. The Dow slid 145 points, that's 0.4%, settling at 38,628. The Nasdaq Composite lost 0.8% to finish at 15,776. All three major indices broke their 5-week winning streaks to end the week in negative territory. And markets are closed in the US today for a public holiday. Treasury yields were higher across the curve last week after January CPI and PPI data came in higher than expected. The yield on the 10-year Treasury closed 4 basis points higher at 4.28% Friday, and at one stage was above the closely watched 4.3% level. The US dollar index posted another winning week. The index was up 0.2% at 104.28. That's the 5th positive week in a row. The yen weakened 0.2% on Friday and was trading at 150 per dollar a day after the country entered a technical recession. Oil prices rallied for the 4th week out of the last 5. April Brent futures added 0.7% Friday to settle at $83.47 a barrel. The global benchmark rose 1.6% for the week, settling at the highest level since January the 26th. Bitcoin rallied 9.5% last week, ending the week at $51,700. It was the fourth straight week of gains for the largest cryptocurrency, as over $2 billion of net inflows poured into spot Bitcoin ETFs last week. Bitcoin ETFs have seen almost $5 billion of net inflows since inception, and during that time, gold ETFs have seen net outflows of over $2 billion. As a result, gold ended 0.5% lower on the week at $2,013 an ounce. In Asian stock markets, Japan's Nikkei 225 came close to breaking its all-time high on Friday. The benchmark index closed at 38,487, just 1.1% short of its all-time high, which was reached on the final day of trading way back in 1989. On Friday, Hong Kong stocks rose ahead of mainland China stock markets reopening today. The Hang Seng Index added 395 points, or 2.4%, to 16,340, and the biggest jump in almost 2 weeks. For the holiday-shortened week, the City's benchmark index was up 3.8% amid reports about a surge in domestic travel in China and robust daily consumer spending on Meituan's online platforms during the Lunar New Year holiday. Futures markets projecting the Hang Seng to open about 15 points lower this morning at around 16,325. And you can get more details on the latest market movements in my daily newsletter, which you'll find at peterlewismoneytalk.substack.com.
Every Monday to Friday, this is Peter Lewis's Money Talk. Peter Lewis's Money Talk.
Let's welcome our guests at the start of a new week. We have with us Alex Wong, Director at Alex K.Y. Wong Asset Management. Morning, Alex.
Hi, morning, Peter.
And also with us is Louis Kuijs, Chief Asia Economist at S&P Global Ratings. Morning to you, Louis.
Morning, Peter.
Now, mainland China markets going to reopen this morning after the Lunar New Year holidays. And as we mentioned earlier, hopes are high among traders for a catch-up rally in Shanghai and Shenzhen. The Hang Seng China Enterprises Index, which is the index of Chinese companies listed in Hong Kong, that rebounded 4.7% last week. And as a result, it's reduced its losses for 2024 so far to 3.6%. In the US, the Nasdaq Golden Dragon China Index jumped 4.3% for the week, and China's benchmark CSI 300 index, which had been down more than 9% year to date in early February, posted a sharp rebound in the days just before the start of the Chinese New Year holiday, and that's pared its losses for the year to just 2% by the close on February the 8th. However, it still left the CSI 300 index down more than 40% from a peak in early 2021. And then on Friday, as you heard, the Hang Seng index adding 2.4% in the biggest jump in almost 2 weeks. It was up 3.8% for the holiday-shortened week last week. So, Alex, we're seeing some rebounds in some of the international indices. What do you think is going to happen once the markets reopen today? Are you optimistic that maybe we're going to see a turnaround?
Well, I think we probably have a bottom in China market for a while now. Sentiment actually is improving, and the spending in Chinese New Year actually is encouraging. So we are seeing some renewed interest in sectors like consumers and internet. So that is a good sign. But I think people be very cautious. So after a higher opening, probably we may see some selling emerging today. So I think we probably may see a high opening, but I don't think it would close at a strong note. We may see some selling on highs today, but I think overall the bottom has been set, and probably we may gradually going higher.
I mean, in the past, when we've seen these rallies for various reasons, whether it be through the support measures from the Chinese government or other reasons, it hasn't lasted very long, has it? We've seen maybe a 3 or 4 day rally, and then it all sort of fizzles out. Do you think this time it could be more sustainable, or do you think we need to see the government take even more action to try and deal with the deeper economic problems?
I think it may not be sustainable to go much higher. Probably the best case scenario we would get is a stabilization, and we probably ranging at a higher level for a while. So that is the best case scenario. I think the government need to do more things, because if you look at the size right now, I think for Chinese New Year spending, this probably would be one of and actually things probably would quiet down after the festival. So I would not pay too much attention to this kind of spike inactivities in the meantime. So I think we need to see more from the government. But in the meantime, I think the overseas strength actually is helping China. And I think people probably would be very cautious to short the market right now. So I think the reduction in short selling interest and also probably maybe see some squaring of those shorts would help the market to stabilize.
Okay. Louis, what's your sense from the early data we've got from the Lunar New Year holiday? Things like hotel sales, Macau visitor numbers. We've also seen some quite positive data from Meituan on the spending on their sort of platforms. What sort of sense are you getting about the domestic economy and particularly consumer spending over the holiday?
Yeah, well, it was pretty good, right? We need to be a little bit careful about the data because it's not completely like for like. Like this was a relatively favorable period, the way that it fell in place. So it's effectively a little longer than last year. Also, it covered Valentine's Day, which is always good for some more spending by young people. But I would say that still, despite those caveats, this was pretty strong data. And I think, we don't want to read too much into one set of numbers, but it is good for confidence. And it's also good, I think it will, domestically be helpful in, helping domestic confidence and people realizing, maybe we're all not falling apart together in this economy. So I think that, this is a pretty helpful set of numbers in terms of that, when you think about what is required in China, and I know nothing about financial markets in terms of what should drive it, but I do think that at the end of the day, stimulus measures can only do so much. At the end of the day, the fundamental push up for markets will have to be a stronger economy, stronger confidence, and so we will have to continue to look at the data for that.
Mm. And do we need to see this be more sustained in terms of consumer spending? Obviously, this is a special time of the year when you would expect, obviously, consumer spending to rebound. But do we need to see this continuing now into next month and beyond?
Yeah, sure. That's what we need to see. But I still don't want to downplay this too much, right? Because the Chinese New Year period is a special period, but that's true every year, right? So and the fact that this year it comes out quite, a bit more generously, I think is by itself a good sign. Again, we don't want to read too much into one set of numbers, but by itself, I would take it as a good sign.
Has this got to be backed up, though, by more policy support, both fiscal and monetary?
Definitely policy support is helpful. I personally don't expect too much on the monetary front. Policymakers don't have an awful lot of room over there, especially not in terms of the interest rate, which they left unchanged, as you also noticed, Peter. Internationally, like US rates are still a bit high, so that's not very conducive if you're looking at your currency as a central bank. I think, the kind of policy measures that would help strengthen confidence in China will have to be on the fiscal side. It doesn't look like there's a huge amount of interest in household-oriented fiscal policy expansion, so I'm not sure what to expect on.
Alex, how are foreign investors likely to take this, do you think? As we know, they have been big sellers of the Chinese markets in recent weeks and months. Do you think they may look at this and think perhaps, the worst is over, consumer spending has rebounded over the holidays, and maybe it's time to start having a nibble at the Chinese market, which by all accounts appears very cheap, doesn't it?
Well, I think they probably still lack interest to pay long term. But in the meantime, I think we may see some short-term interest. And also, I think we may see more short covering. And I don't think that people would go short against this market aggressively now, because these things actually looks to have been stabilizing. So I think we probably may see some period of stabilization in the Chinese market. But I doubt the long-term interest, because among the global market, actually China is the one which is least favorable for AI concept because of the constraint on chips. And I think that's the key long-term story in the market right now. So I think it is still lacking the it charisma to drive global interest towards China, despite the apparently cheap valuation.
I mean, we're hearing sort of reports that actually foreign investors, if they want to want an exposure to China, they're looking at other ways of getting that without actually buying Chinese stocks. So, for example, buying things like European luxury goods companies like LVMH and so on as a better way of profiting from a potential recovery in China. Are you seeing signs of that?
Yeah, of course, LVMH actually led the luxury stocks much higher since the last report. I think this will still be the trend because the underlying assumption is the questioning of Chinese brand pricing power. I think that is the key issue right now because even though activities may be strong, but they compete very strongly amongst each other, and the pricing power actually is not that good. So people are more confident in those European names or even Japanese names because they actually have the brand power to charge higher on consumer and they have a more stable demand. So I think this is the underlying assumption. So this may continue. This is not just a market preference. I think this is the fundamental issue on pricing power among the Chinese names.
And they're also, investors are going to face this news that MSCI is removing 66 names from the MSCI China index and reducing the weighting once again in the index to about 25%. What sort of impact is that going to have?
Yeah, of course, they will strike some outflow because of this decline in rating. I think this is the results of the weakness in the Chinese market because many of those names probably would see a huge foreign market cap in the last year. So I think that this is the results of the weakness. But of course, I think this would drive most outflows and people are more interested in other markets. And we have more and more products ex-China. So I think this is the long-term negative factor for China because I think passive funds actually are looking more products excluding China.
Louis, on the economy, the next big event, I think, is going to be the two sessions, which starts on the 4th to 5th of March. I mean, I think it's fair to say, isn't it, this year there's a higher than usual level of uncertainty about this. But what can we look forward to? What should we expect from that?
Yeah, it's a good question. These sessions tell us especially about about economic policies this year, right? And so on the macro front, as I just mentioned, I'm not sure that you will get to see a lot of language that is, I'm sure you'll see positive language that we will support the economy, but I'm not sure that we will get an awful lot of, specific initiatives on fiscal and or monetary easing. And so then the attention will look at what are the types of measures that the government seems to be talking about in terms of structural reforms, structural reforms to either boost productivity or increase the quality of urbanization. These are really the two main strands of structural reform in China that we are looking at. I think that where I'm pretty sure that we'll see a lot of language on in these policy documents is that language on high quality development. We need to, make sure that we are there in the high tech area. So a lot of attention and probably even some initiatives to boost investment in those higher tech sectors. I'm not sure that how much we will see on the consumption front.
And of course, one of the things we want to see is some sort of initiatives on the property sector. I mean, the news we seem to be hearing from Beijing is where they seem to be moving towards is to have the state play a bigger role in the provision of housing in China because of the things that have happened to the private developers. How do you think people will react to that?
I'm not sure that there is a, the grand scheme to increase the role of the state. What is true is that we've seen a lot of private sector developers being in huge trouble, and that the authorities have been for a long time already interested in more concentration. A smaller number of property developers, and so they have been in favor of concentration. Often the strong names are state supported or state owned. So yes, there has been a trend, and that may continue. The other thing on the role of the state is that there has been that emphasis, right, on whatever is happening to these companies. We need to make sure that the houses that they started, the apartments, will be finished and that people can live somewhere. So unfortunately, for the people who worry about this, the role of the state may indeed strengthen, whether or not this was part of a master plan.
And are we going to see a target once again of around 5% GDP growth in 2024, do you think?
That seems to be the chatter. That seems to be the gut feeling. And also, people have been surprised by how ambitious many of the provincial growth targets have been. We've seen a trend, right, in the last 10 years or so of gradually more modest growth targets. This year, we may not see a lower target than last year. Last year, the phrasing was around 5%, and we'll probably get something like that this time around.
Alex, what do you think market participants want to see? Obviously, we've got the property crisis, weak consumer confidence. We've also got deflation pressures as well. And at the same time, the government seems to be reluctant, as Louis was saying, to make any big changes on the monetary front. We saw the MLF left unchanged yesterday. We got the loan prime rate decision on Tuesday. What do you think investors would like to see?
I think they would still like to see some things on the monetary side, but I think that they need to see the US dollar to weaken first, because renminbi actually is a key concern for China. So probably nothing much can be done now. The support for the housing market actually could be just to finish those projects, but I don't think that it would change the overall sentiment much. So I think you need to see something on the monetary side, but the key thing is probably we need to see the US dollar weaken across the board first.
And that's got to happen before China's going to start cutting rates or the RRR, because presumably it's worried about any potential slide in the yuan.
I think RRR cut probably may still be seen, because this may not be affecting too much on the forex rate, but I think the rates probably may be cut after the US dollar weakens. Yeah.
Okay. Let's turn our attention to a couple of other economies in the region. Louis, perhaps I can ask you first of all about Singapore. We had the budget on Friday. Overall, what was your thoughts about that? Was it a business-friendly budget? They were talking about making cuts to business tax rates, corporate income tax, or getting a rebate anyway on corporate income tax, also support for households. What is your sort of overall high-level view of that?
Yeah, I don't follow Singapore super closely. My colleague does that from Singapore. It seems to be a budget that it seems to be a pretty skilled budget, in the sense that they are able to highlight many tax cuts, and somehow at the same time the budget deficit, the balance is not expected to worsen a lot. So it has been fairly balanced. In looking at how can we present a budget that seems to be, pretty positive for people and business, while not draining our fiscal coffers too much.
And I presume that's because there's a legal requirement, isn't there? A constitutional requirement in Singapore for the government to maintain a balanced budget over each parliamentary term. So it can't really do what has been allowed to happen in Hong Kong and start running big deficits.
That's right. And they don't really need to, they're overseeing pretty solid growth at the moment. It wasn't great in Q4, but it's still, the medium-term story on Singapore is still pretty positive. So I don't think there is a strong need in Singapore to add lots of inflation pressure to an economy where inflation is actually still one of the key concerns.
And of course, whenever we have the Singapore budget, it's always a couple of weeks before Hong Kong's budget. So there's always comparisons. I think the financial secretary here has got a difficult situation to deal with, hasn't he, with the deficits getting larger, certainly much larger than predicted at the beginning of the financial year. Maybe it's going to be difficult for him to be able to do the sort of rebates and consumption voucher schemes that he's done in the past.
Yeah, that's definitely right. So Hong Kong's fiscal narrative, its fiscal arithmetic has changed somewhat. I still have to say, from a G7 or like European perspective, this still looks like pretty solid, right? It's weird, if you look at where Hong Kong's government debt is as a share of its GDP, then that will keep you pretty relaxed.
Alex, what are your thoughts here? It's obviously a sort of a fairly good balancing act down in Singapore. Going to be much tougher for Paul Chan to do the same thing here in Hong Kong.
Yeah, I think, of course, Hong Kong probably need to raise that, I think, because the major revenue from land sales actually is vanishing right now. So I think Hong Kong is difficult. I think probably Paul Chan would try to reduce the expense side, but the point is we don't have too much a new revenue source. So I think that is quite difficult for him. Probably we need to see more debt raising in Hong Kong.
It's really, if he wants new revenues, the only way now is there's got to be really quite a big overhaul of the tax system here in general, hasn't there, to make it more balanced and have sort of a broader tax base.
Yeah, but the point is a broader tax base actually is not welcomed by the business community, especially right now the economy is in a downturn here. So I think that that's make it more difficult for him to broaden the tax base.
It makes you wonder, how is the government going to be able to afford things like the Northern Metropolis and the Lantau Islands sort of projects? These are huge expenditure sort of projects when our deficits are getting bigger and our reserves are shrinking.
Yeah, it is. It's very difficult. Probably so I think the only way is to try to raise that on probably more project-related debt raising. That should be done to finish those kinds of things if they want to.
Okay. Louis, can I ask you about Japan? The economy slipped into a technical recession there. We saw the data last week, contracted 0.4% in the final quarter of last year. That was after a contraction of 3.3% in the previous quarter. So I suppose that does count, doesn't it, as a technical recession. Are you surprised?
No, we were not that surprised because we had Japanese data tends to be quite bumpy. We had a super strong Q2, and despite the technical recession, I personally really don't like that R word because it doesn't always say very much, right? We had minus 0.1% shrinkage of the economy in Q4, quarter on quarter, and so one airplane or so would make the difference between that and positive growth. But the Japanese economy is a mature one where, despite all the monetary largesse, domestic spending is never going to grow very fast. Where our projection for potential output growth, right, the kind of trend growth that you could expect is around 1%. So, and we had 1.9% growth last year, despite that technical recession. So, I think the Japanese economy will never power away, but I wouldn't read too much into that quite bumpy data.
And if you look at other data, I mean, the country's unemployment rate's at an 11-month low, so the labour market seems quite good. The Bank of Japan's Tankan surveys seem to show businesses reasonably optimistic at the moment, don't they? So it sort of rather defies the fact that Japan is technically in a recession. Yeah,
I think if you were to focus on that annual number, we had 1.9% GDP growth last year in Japan. We haven't had that in quite a while. That's a pretty good number. So I think indeed, as you say, on the business side, the manufacturers in high tech and capital goods sectors have become more optimistic. On the spending side, things are still not too bad amidst a very strong labor market. And I think what the Bank of Japan is going to look at most closely in the coming months is that labor market data. is the spring round, are the wage negotiations going to show a solid solid rate of wage growth? That is what the Bank of Japan is looking for as a condition to eventually move away from the negative interest rates.
Alex, what about the Japanese markets? On Friday, the Nikkei 225 got to within 100 points of its record high that it reached back in 1989. In fact, the last day of trading in December 1989, it got to 38,915. I assume that the traders are going to get it there, aren't they? But what happens after that?
I think it probably will still be going higher. I think people like Japan right now, despite the latest round of data, I think people like the high-end manufacturing sectors, like the anime sectors, even though we are seeing weakness in the domestic sectors, but I think Japan is a well-balanced market, and people like those sectors, and that will support the overall market. I think Japan probably will still be going higher.
And how much is the weak yen giving a boost to the market?
It's helping. But I think last year we got a dollar yen dip to around 140, and at that time the correction in the overall market actually is not that much. So that is showing some resilience in the Japanese equity market. I think, of course, a volatile yen probably would be hurting the market, but I think overall people probably will expect a more stable yen, and probably the yen probably may not be strengthening too much despite the tightening bias of BOJ. So I think that will not affect too much. And Japan actually has some more domestic name, which is not doing too much right now. So a reversal in yen probably may help to get some more interest in those domestic names eventually. So I think that will not affect the overall sentiment in the Japanese equity market too much.
And are you seeing signs that money is coming out of China and into Japan, and Chinese investors themselves are moving money into Japan?
Yeah, if you look at those ETF in China, actually China is looking elsewhere to park their money. So not just Japan, I think even US, people are trying to park their money on equities elsewhere, because Chinese equities actually perform very poorly in the long term. And they are looking ways to park the money, and I think they probably even don't trust a bank deposit too much, because they probably may be questioned on a huge amount of deposit stacking. So I think they are looking elsewhere to park the money.
Okay. Louis, finally, let me just get your thoughts on the US economy. The key data last week was the consumer price index and the producer price index, both of which came in higher than expected. And as a result, we've seen quite a big repricing now in traders' expectations for rate cuts. They were at the beginning of the week pricing in almost 6 rate cuts this year. That's come down to just over 3 now. Is that justified, do you think, or do you think people are overreacting to this data?
The market tends to be quite volatile on this, right? The market gets at times very enthusiastic, when we think they got way too enthusiastic late last year. So my US colleague expects inflation, the further decrease in inflation to be not that easy, and has been having 75 basis points cuts starting mid-2024 in his baseline for quite some time. And so our forecast doesn't change as much as the market one. And we think that where the market currently is more realistic than where they were, say, a month ago.
Alex, and from a market perspective, we had a 5-week winning run for the US markets. That came to an end last week. We've seen Treasury yields jump higher. The 10-year yield now is coming back close to that sort of key level of 4.3%. What are your thoughts on how the markets are going to react to this if traders have to really start rethinking their expectations about rate cuts?
Well, I think market just ignore that. This year we have a strong divergence between the bond market and the stock market. Mm-hmm. So in the stock market, I think the strength is driven by retail interest, and I think retail investors are more focusing on a long-term simple story. So they are gathering because of AI, And if you look at the names like ARM and Supermicro Computer, actually, this is just the repeat of what we have seen in GameStop, probably. So we are seeing an enlarged version of a GameStop in the US right now, and there are more and more retail coming towards the market because of AI. So I think this would continue to support the overall market. So if you want to see the reaction on macro data, actually the bond market is more reflective. So I think overall US market is still okay, but the latest concern would be AI, name killing AI, because if you look at the price action of Adobe or Google last week, they are affected by new products from OpenAI. So I think this is a new concern. So very likely we may see the index to lose some momentum. And I think individual names will still be hot. So people probably would concentrate their bets more on certain names and then use the index to hedge. So very likely, I think we may see the index to lose some momentum.
Okay, well, thank you very much for your thoughts. You heard there Alex Wong, who's director at Alex K.Y. Wong Asset Management, and Louis Kuijs, who's chief Asia Economist at S&P Global Ratings.
Peter Lewis's Money Talk.
I'm joined now by Andy Scher, who's a Shanghai-based independent economist. Morning, Andy.
Good morning, Peter.
Let me get your thoughts about the spending data that's been coming out of China over the Lunar New Year holidays. It seems to be pretty good initially, doesn't it? We seem to have seen increased spending on platforms like Meituan, on hotel spending. What's your sense of how it's gone over the last week or so?
Yeah, we're seeing the continuing trend of big growth in domestic tourism. That appears to be not just a one-time thing, and people are really love to get around. And it's partly thanks to the high-speed rail system that has made traveling inside China cheap, fast. So I think that the demand is very strong. And you look at Shanghai's airports compared to last year during the similar period, up quite a lot, like 80%. Yeah.
Do you think we're back to where we were now pre sort of pandemic in terms of holiday spending?
Way before, way above.
Okay.
Yeah. I think that something new is happening. They are not traveling overseas like before. I think that there's a big change in spending pattern. And overseas destinations, obviously, the international environment is not that really friendly to Chinese tourists. This is one. The second is that Chinese tourists now feel that it's not safe in many countries. So that's a new factor that people changing spending behavior.
Are they interested in coming to Hong Kong?
Well, Hong Kong offers shopping. I think that there we see a significant change in preference. People like experience. Hong Kong doesn't offer much. Hong Kong is just a shopping center.
Whereas elsewhere in China, there's lots of beautiful scenery and things to do as well that may be more attractive. Are they spending?
People want to have things to do.
And are they spending as much on these visits, or are they sort of tightening their belts a bit? And when they do these trips, being more cost conscious?
Well, I think that the market is highly competitive inside China. We see that the services like hotel services, lots of places have upgraded, but the prices have not. Sometimes have gone down. So it's very competitive. So, good value is also a reason why the demand is up a lot. So in a way that Chinese domestic tourism is in a virtuous cycle. It's a big market, very competitive. The service is good value, and the high-speed rail offers convenience, speed, and a low price.
So what does this mean going forward now that the holidays are over? Is this enough to sort of rebuild consumer confidence and keep that consumer spending going over the coming weeks and months?
I think consumer spending is still okay for middle class. Now, last year, domestic tourism rose by more than double to over 4% of GDP. And probably this year, we'll continue to see 20 to 30% growth. So it will add another 1 percentage point or a bit more to GDP. So I think that but the high end, you go to high end, very expensive restaurants or luxury shops, there you see demand is really crashing.
Right.
Because their patrons are really tied up with the sectors that are deflating, like property and shadow banking, and also internet sector is not doing well. These are where cash-rich people used to get their money from. So it's not anymore.
So I presume that the underlying economic problems haven't gone away. Things like deflation, the proper problems in the property sector, and so on. These problems are still there and have still got to be dealt with by Beijing.
Well, I think these problems really need time to resolve. It was a bubble to begin with. And I think the reallocation of money from these sectors to middle class is a healthy development. Think about it. People are not borrowing money like before to purchase overvalued properties that they don't need. And they bought because they believed in a rising price. So now the household sector takes on less debt and has more spending power. Why is that a bad thing? Right? Over time, it's a good thing. We just need to work down this inventory, this huge inventory. It takes years. And all these shadow bankers who basically were creating, we're not creating value. They actually added a negative value to the economy and got rich on it. These people need to go somewhere else.
And those losses are still there, aren't they, in the system? Someone's still got to take those losses.
I think that they don't want to walk away. They still believe that they can get something out of it. I doubt it. I think it's the best is for these guys to close shop and move on. And I think that obviously the state bank financial system will suffer losses too. But I think that it takes, give it 10 years, the bill can be paid.
10 years. So we're going to have to wait a while then.
Yeah. I think no property bubble problem gets resolved quickly. It's not likely.
So the next big event now is the two sessions, the 4th to 5th of March. What can we expect from that in terms of policy initiatives? Are we likely to see anything new, do you think, from that?
Well, I think that these the double sessions are not as important as before because now the system is run differently. It's much more concentrated. Power is much more concentrated, and used to be like ministers were big shots. They would come out to make statements, almost like policy statements. Obviously, now ministers are just execution. They do execution. They really don't have any policy authority. So a big conference like that don't mean a lot anymore.
So what should we expect from the government? They still seem to be reluctant, don't they, to do any sort of monetary easing. We saw the MLF left unchanged yesterday. No, We've got the loan prime rate decision Tuesday, but it doesn't seem to be any sign of any monetary easing at all.
No, I think that the key is that the government understands if you waste a lot of money to revive the economy, it does not improve the country's security situation. Okay, And I think the Communist Party feels existential threat. That is really guiding its policies, and to some extent, it's really a good thing. If you waste money, trillions of dollars to revive the economy, what does that mean? You have a GDP. Is that a good GDP? But on the other side, you need to see concrete results in terms of technology self-reliance. So you can waste money there. And there you improve the country's security down the road. So I think the market is not getting the right because they are always praying for macro stimulus. It is not coming. It's just that the United States has basically made China's policy a priority. And the U.S.'s containment tactics are forcing the hand. So I don't think that you're going to see big stimulus like before. It's just going to be like that in terms of a macroeconomic situation.
So investors are going to be disappointed by the sounds of it then. So where does all this market support, where does that fit in? Is that also sort of a waste of money? Because they seem to be spending a lot of money on buying ETFs, buying stocks to try and support the market.
No, I think that's a very little, direct support is very little money, and mostly relying on financial institutions, like forcing mutual funds not to sell. And so this is a non-market tactic. I'm not sure that you can boost the confidence a little by showing that you care, right? But in terms of the amount of money involved, whatever amount of money involved is very small. We're talking about billions of dollars. If you want to get the macro going, we're talking about trillions of dollars, probably $10 trillion. So that is for China as a whole. Whatever they are doing via stock market is minimal.
Does it work at all anyway, even if you do provide large amounts of stimulus for the market? It only seems to have short-term benefits anyway. You get a rebound for a few days and then the market sells off again.
Yeah, and I think that it's just buying time to show that the government cares. So you guys should not all sell. I think the issue is that the selling pressure really comes from something called the Minsk effect, because the shadow banking system traps like a 50 trillion US dollar equivalent of assets, basically not liquid anymore. So if anybody who needs money, he's going to sell stocks to where there is still liquidity.
Right.
Actually, the property market is not liquid at this point. You just can't sell. A lot of people are sitting on these empty flats and investing in shadow banking. All these people, most rich people in China, were fully involved in the bubble economy. So now they have a liquidity pressure. So what they're going to sell? The only thing they can sell is stocks.
And I suppose at the end of the day, one of the big problems that the government, someone somewhere has got to try and deal with is deflation. There is still deflation in the economy.
Well, deflation per se is not a problem. Why the price is going down is a problem. And if it becomes a problem only if it's driven by declining money supply or shrinking money supply, and you get into companies going bust. That's not the case here. The money supply is still rising at 10%. So I think that the prices are going down partly due to supply catching up, partly due to good competition, like in the automobile sector, maybe a bit excessive at this point. But the car price is going down, that's a big part of this deflation story. And the pork price is going down. That's another big story. But both I don't see anything bad. Pork supply is going up. Why is that a bad thing?
Okay, well, it'll be interesting to see what they say when we do get to the two sessions. Andy, thank you very much indeed for your thoughts this morning. That's Shanghai-based independent economist Andy Scher.
You're listening to Peter Lewis's Money Talk.
Money Talk.
Thank you for listening this morning. Do please take a look at my daily newsletter, which has more information on some of the topics we've discussed today. You'll find that at peterlewismoneytalk.substack.com. I'll be back with another show tomorrow. Joining me then will be Mark Michelson, Chairman of the Asia CEO Forum at IMA Asia, John Schofield, Managing Director of Tempus Investment, and our US economics correspondent, writer and broadcaster, Barry Woods. See you tomorrow.
Money Talk